Are you there?
Yes, sir.
Okay. Then cash and cash equivalents, and the note the breakdown is given. Cash at bank 360 million, cash in hand 33 million, and investment in fixed deposits, maturity within 3 months 191. So up to 3 months maturity fixed deposits also they considered as cash and cash equivalents, and the total is 585, and the bank overdraft 1.14 billion. So they have bank OD of 1.14 billion, and the net cash and cash equivalents with OD negative 861 million. Right. So this is the note 861 million, and then the bank overdraft used for cash management purposes. So they say the bank OD they didn't classify as borrowings, or they use it as cash, right? And they say use it for cash management purposes. For me, if it is borrowings, whether it's cash management or whatever, it should be borrowings, right? And if you pay interest and see the rates, HNB charging AWPLR plus 1.5, and the limit is 650, and so they exceeded the limit also. I don't know limit. Yeah, they say 650, and the balance is 780. So they exceeded the balance, and DFCC AWPLR plus 0.075, and Sampath Bank AWPLR plus 1.5, and Commercial Bank AWPLR plus 2%, and Senan Bank AWPLR plus 2.5, and this is their OD, and also the security. There's a corporate guarantee of Navaloka Hospital Private Limited, and director's personal guarantee, and yes, and assignments of debit card, credit card issuable to Navaloka, the Selinco Selan Bank, right? Okay. And the company details, company bank overdraft, I'm not going to go through all. And assets held for sale balance, right? Right, read this note. This they say held for sale. Navaloka Hospital PLC signed a MOU with Metropolis Healthcare Limited. And it was a joint venture. I can remember 2015. They have a joint venture, 50-50 joint venture between Navaloka Hospital and this Metropolis. And now this time they exited from that investment and they sold that investment. That's why it's no more there, right? So I read the note. I'm not going to go through it again. And stated capital 1.2 billion company and the group, and 1.2 billion company, and the same amount you can see here also, right? So this is due to consolidation. Can you remember? I explained this also. Then revaluation reserve 1.8 billion group, right? They have a revaluation reserve of 1. So they say the revaluation reserve relates to revaluation of building on leasehold lands and represent their fair value changes of the building on leasehold lands as at the date of revaluation. So they revalued building on leasehold lands, and so this is the revaluation reserve. They have a reserve of 1 billion. And debentures, right? So they issued debentures, and non-current value is 186 million, and current value, no current value. The meaning is all long-term debentures. And even I think this is these debentures issued by the company, and last year 455 million, and that had been settled during the year. And they say during the financial year 2013-14, the company has issued 1.5 billion rated unsecured redeemable debentures at par value of 100, and allocation is as follows. So during the year 13-14, they issued 1.5 billion worth of debentures, and these are the periods and the details, right? Issue date and everything is there, right? And the market summary, the meaning is the debenture prices, and the 103, 103.5 is the debenture prices. Credit rating given by ICRA and BBB rated debenture, right? Then contribution to defined contribution plan, right? What is this? What is this? Contribution to defined contribution plan. What's this? Huh?
EPF.
Yeah, speak loudly. Yeah, I can't hear you clearly. EPF, ETF, yes. EPF, ETS, employers contribution and employers contribution, employee provident fund and ETF, right? And then present value of defined benefit obligations, right? What is this? Gratuity. So the gratuity liability as of the balance sheet date is 305 million. How do you estimate this gratuity liability?
Like the total employees and year of working into the gratuity payable.
Yes, right. So let me explain it with using the example, the Excel sheet. Right. So how do you estimate gratuity? Can you see the Excel sheet?
Yes, sir.
Okay. So we take the salary, right? Or let's say salary of the salary of an employee, let's say 100,000, right? Monthly salary 100,000, and he worked for this company for service or experience, right? 5 years, or let's say 6 years, right? And the current month salary is 100,000, and his service, and he has been working for the company for 6 years. And what's his gratuity liability if he resigns today? What's the amount payable to him if he resigns today?
300,000.
Yes. So 100,000 divided by 2, half month salary, into number of years is 300,000. So this is the gratuity liability if this employee leaves today. So we need to pay 300,000 to him, right? But how do you estimate company's gratuity liability? If a person leaves, so on that date you can estimate your gratuity liability. But as a company, we need to provide for gratuity, right? If an employee joins today, from the first month onward, you need to provide for gratuity, right? If an employee works for 20 years, so during that 20-year period, throughout the period, we need to provide for gratuity. How do you estimate gratuity liability, right? Again, as I told you, the traditional method, those days before IFRS implementation, how you calculate gratuity liability? By using this method, right? So end of the year, we take the salaries of all employees, individual salaries detail, and also we take the period of employment, how many years they work for the company, and based on that, we calculate the gratuity liability, right? If an employee joined 1 year ago, if the experience is 1 year, and we take half of one salary. If the employee experience is 2 years, we take full month salary. If it is 4 years, right? So salary divided by 2 into number of years, right? This is how we estimated gratuity liability those days, not now, right? Now, we can't estimate this. We need to assign this to a chartered actuary. right? Chartered actuaries are there. They do the gratuity valuation, right? They estimate the gratuity liability. How they estimate? To estimate gratuity liability, right? You should know each and every employee's the salary at the time of resignation, right? So if a person is retiring in 60 years or 55 years, so at the time of resignation or retirement, you should know his salary, right? So therefore, one assumption that they need to make is the salary increase rate. Right? So average salary increment rate for next 5 years, the 20 years, you should know, right? Why? To estimate gratuity liability of an employee, you should know the salary of that employee at the time of resignation or the retirement, not the current salary. So therefore, to estimate his salary at the time of resignation or the retirement date, you need to calculate future salary increase rates. So we need to provide the company need to provide the salary increase rates of the company to the chartered actuary, the one who is doing the valuation. And not only that, and they also need to know the labor turnover rate of the company. Again, not a company-wise, the overall company labor turnover ratio. So they group, right? So 22, let's say 18 to 25 labor turnover rates, and 25 to 30, or sometimes even take the overall labor turnover rates, and based on the labor turnover rates, they decide how long you are going to stay with us or the organization. And if you work for 5 years, you get 5 years gratuity. And if you work for 10 years, you are entitled for only for 10 years. So likewise, individual employees, we need to estimate the date of retirement for the number of years that they are going to work with the company, right? Based on the labor turnover rates. And also, the next assumption is the mortality rate of the country, right? So there is a probability, and there's a table, and based on that we can estimate the mortality rates, right? So at the age of 20, what's the probability of dying, right? So 30, so what's the probability? Though we think that there is no probability, right? Even for us, there's a probability, and calculated for the country. So that rate they use, that mortality rate they use in calculating the estimating gratuity liability. And also, in addition to that, they need to use the discount rate, right? So the chartered actuary, what they do is they estimate the number of years that you are going to work with the company, and at that date, the salary, let's say in 20 years time, what would be your salary, that they need to estimate. And also thereafter, you need to calculate the gratuity liability in 20 years time, and you need to discount it by the discount rate and calculate the present value of gratuity liability in 20 years. So present, so you estimate 20 years time liability, and you need discount and calculate the present value as at today. So that's your actual gratuity liability, right? That's your gratuity liability. And these calculations given by the chartered actuary, and you need to provide the assumptions, right? Salary increment rate, discount rate, then labor turnover rate, and mortality rate. They take from a sense of statistics or some other source, and all other assumptions we need to provide to the chartered actuary. Then they make the gratuity liability. And if I go back to the annual report, so the liability, so they say present value of defined benefit obligations. They estimated the future liability and discounted and calculated the present value. This is the present value of defined benefit obligation, right? And this is how you estimate the gratuity liability. And these bit technical. I'm not going to explain this. What is interest cost, current service cost, actuarial losses, and all. I'm not going to explain. And yeah, so let's see the assumptions. Right. See this. So one assumption is retirement age. They say 55, and discount rate 10.5. Right. Discount rate 10.5. Right. Yeah. Somebody else is also using Met. So don't use use this screen. Right. What you write, we also can hear, see. Right. Okay. These are the assumptions. Retirement age 55 and discount rate 10.5 and salary increment rate 8%. Right. So the Navaloka Hospital for next 20 years, they say average increment rate is 8% and the staff turnover rate, labor turnover rate is 14%. Right. So based on these assumptions, they calculated the gratuity liability, and also they have done a sensitivity analysis of the gratuity liability and what will happen if the discount rate increased by 1% and if the discount rate reduced by 1% and salary increment rates increased by 1%. So this is a sensitivity analysis. And just for you to understand the sensitivity of these assumptions, right? Okay. Deferred tax liability, I explained last time. Can you remember? I use Excel sheet, and why we provide for deferred tax, I explained. And the main reason is to minimize the fluctuations of profits or tax expense due to the temporary difference between accounting depreciation and tax depreciation. Right? Accounting depreciation and tax depreciations are different. Therefore, you pay a higher amount or lower amount of tax in some years, and you pay a higher amount of tax in some other years. Therefore, to minimize these fluctuations, we can use deferred tax provision. It's an accounting entry. And last time I took one example, Excel sheet, and hope I emailed it to Nipunika. Hope she uploaded this document, Excel sheet, deferred tax. Right. And movement in deferred tax, not going to go through. Yeah. Deferred tax is the lengthy note. Borrowings from financial institutions, right? Borrowings from financial institutions. So this is the borrowings, right? Financial institutions. What's their total borrowings? Company or the group? Total borrowings, company? Huh?
5 billion.
Yeah, let's see. Right, if you go to balance sheet, you can see they say borrowings from financial institutions. Other borrowings is not there. Right, I think debentures they disclose separately. It's also part of borrowing. The bank OD also, I think, not included here. Right, and yeah, so the only borrowings from financial institutions included here. And the opening balance 4 billion, company, and the group 7 billion, and exchange losses are there. Then loan obtained during the year 5 billion they obtained, and also paid during the year 5 billion, and interest charged for the year 493 million. Right. So if you can recover your related party receivable, you can settle all these borrowings. Right. Your related party receivable is also 5 billion, and the bank borrowings from the financial institute also 5 billion, and your interest cost is 500 million. So you can improve your profitability by 500 million. Right, this is 493 and close to 500 million. Therefore, you can have an interest saving of 500 million if we can collect related party receivables. Right. So then they classify this as current portion and non-current portion, amount payable within 1 year and after 1 year, and amount within 1 year 1.8 billion and after 1 year 3.1 billion. Then the bank-wise borrowings. Right. So who provide the highest amount of borrowings? commercial bank, right? Or Sampath Bank. Sampath, no.
International.
Yeah, at National Bank, right? So if you take the group, the highest amount provided by Het National Bank 3 billion, and NTB 1.9 billion, and Sampath Bank 935 million, and Commercial Bank 861 million. So this is the bank-wise breakdown. Bank of Ceylon also 380 million, right? And so this is the breakdown, right? And yeah. Then commercial paper borrowings, right? They borrow. What's the commercial paper? Commercial papers? Are you aware of commercial papers? So it's like a promissory note, right? Commercial paper is like a promissory note, and again a financial instrument that you can use to borrow money, right? Not for individuals. Commercial papers are used by corporates, and the difference between a debenture and the commercial paper is debenture is long term, but commercial papers are short term. So normally less than 1 year, right? Therefore, when you estimate borrowings, right, you need to take the commercial papers as well. When you estimate your borrowings, it's also part of borrowings, and 34.1 is borrowings from financial institutions, right? And this is commercial paper borrowings, right? I hope they borrowed from corporates, right? And the total is total borrowings, commercial paper borrowings. How much?
9 billion.
9 billion. No, commercial paper, I think 1.5 billion. 1.5 billion. Right? 1.5 billion, and all short term. And so this is total borrowings of the including commercial papers 9 billion, and this is 6.5 billion, right? But the bank OD, I think it's not included here, right? Bank OD they disclose separately. So this 9 billion of 6.5 billion other than OD. Then the details of borrowings and repayment terms, security, financial institute, principal amount, interest rate, annual repayment, everything is there, right? So if you want to need, the lot of bankers are here, right? Number of bankers in understand. You all can go through this note and see the rates given by other banks, and also what kind of securities they obtain from Nalok Hospital, right? And so you can see the mortgage over company shares, 100% Nalok Medicare Center Private Limited, Sampath Bank, right? Loan agreement and shares they take. Bank of Ceylon joint and several guarantee of the directors, right? So based on the personal guarantee, the Bank of Ceylon given this loan, and Sampath Bank mortgage over Navaloka Medicare Private Limited, right? So I don't know whether it's share. So mortgage over, what's the meaning of this? This mortgage over Navaloka Medicare Private Limited. The banker, some of the bankers, you all can help me. What is this? Yeah, a lot of. So Sampath Bank staff also here, right? Mortgage over Navaloka Medicare Private Limited. So the previous one, Bank of Ceylon, they specifically mentioned the shares of this one, mortgage or company shares. Is it difference or same? Huh? This one, security is mortgage company shares 100% of Navaloka Medical Center Private Limited. Here they say mortgage or Navaloka Medicare Private Limited. Same company, right? I don't know whether it's secondary mortgage, right? It's not clear. They say mortgage. I don't know whether it's shares or something else, right? It's not clear. Then commercial bank primary mortgage bond over debit and credit card sales for 1.2 billion, right? And debit and credit card receivables, I think the 1.2 billion, and they have provided a facility, and also corporate guarantee from Navaloka Hospital Private Limited for 500 million, and signed by the directors of the company, corporate guarantee from New Navaloka Medicare Center Private Limited, right? So they use corporate guarantee in addition to these receivables.
So is this disclosure of details are as per the new requirements? Is that right?
This mandatory. All the annual reports, you can see the borrowings details.
In the details of this much, is it?
Yes. So security, the interest rate, and the repayment terms, everything you can see. If it is a listed company, all the listed companies disclose this, right? So I think this is useful for the bankers. If this is the existing customer, and you can compare your interest rate with the competitors, the other banks, and what kind of security they provide, right? And commercial bank is a USD loan, LIBOR plus 4.5, right? It's a clean, and 5 years, 59 months install.
What do you mean by clean?
Yeah. Yeah. So what is meant by clean? Huh? No security. No security. So this facility provided without any security, right? Clean. Even most of the time you get the personal loan clean basis. You don't need securities. If you are a professional, most of the banks, they are willing to give you facilities, right? That's the meaning, right? When you say clean.
Based on your financial strength, right?
Sorry?
It's based on your financial strength, right?
Yes, yes. Based on your financial strength. So without any securities. And that's why if you are a professional, you can get a loan from a bank. Most of the banks offer credit facilities to professionals and without any securities, right? So you can get clean based on your financial strengths. And HNB also a clean facility, AWPLR plus 1.75, and International Bank, number of facilities are there, right? And NTB, and so all the details are there, right? So read it leisurely. Not going to go through all. Then lease liabilities, again borrowing, another form. So they have OD, bank borrowings, debentures, commercial papers, lease payables, right? And the outstanding balance 596 million. 596 million outstanding balance. The group 596 million, company 61 million. Okay. So details of the lease. Okay, then trade and other payables, right? So trade payables, related party payables, 53 million. So they have less amount payable to related parties, but there are a number of receivables. The receivable value is more, right? And others 873 million payable, and doctor payable 108 million, and total 1 billion company payables. And so in addition to that, there's a 600 billion other payable. I don't know, the narration is not given, right? Total payable, trade payables, they say all trade, and 1.6 billion, company 1.3 billion, right? And current tax liability, they say 18 million they need to pay. And so see, opening balance is a negative, and over provision during the year 3 billion, and provision for the year 28 million, and claim against ESC. So if you have paid ESC, you can claim. Then the balance is 18 million. Then amounts due to related parties. Was the previous note that we went through? Was the previous note?
Receivables.
Huh?
It was receivable.
Yeah, that's related party receivables. So this is payable to related parties. What's the total? Total
49 million.
49 million. Which one is more?
That was 5.5 billion.
Yes. So the company payable is 384 and company receivable 5.4 billion or 5.5 billion. Right? Receivables more. Right? And the details given. Now look at petroleum, Batramulla Medical Center. Again, the same way they disclose. Payables also. Right? And the same footnote is there. Again, this is not new now local. Here also they say now local, right? We can't say it's a printing mistake, right? So these are different company, not the subsidiary company.
So small question there. Now we see similar names in both payables and receivables. So
Yeah,
can't the company like set off the balances? No.
Yeah. If you can set off, if these transactions are different, you can't set off, right? Let's say, you know, if there are, you purchase something from a related company, right? And you purchase something from a related company, therefore it's a payable. And when you settle money, you need to settle it. So then you can net off the amount payable and the amount paid. And also they purchase from you is your sales, and you need to collect it. So those two you need to disclose separately. Your purchase transaction, your sales transaction, your receivable payable, you need to disclose separately.
Okay.
Right. Right. If you understand, if you can understand, try to understand this as well. Right. I thought of fair value measurements. Right. This is a new thing. Right. And you need to fair value some of the assets. And so this is the breakdown of those assets, fair values. Right. So how they say fair value through OCI, other comprehensive income. This is the value, this is the fair value, right? So with the new accounting standards, you need to disclose the fair values of most of the assets. So that's why you disclose fair values. And also here you can see level 1 and level 2, right? Sorry. Yes, right? And I'm not going to explain all, but just to understand level 1, when you say level 1, right? If you can take, if there's an active market for this instrument or this asset, let's say a listed company share. If the company, if the company where you invested, if that company is listed, so then you can take the market price from the stock market. So then you can take the market. It's observable. And if somebody wants to double check the accuracy of the value, so they can go to stock market and take the last share price and compare with your valuation. So then, so this is called level 1, a good fair value. Fair value estimate is accurate. And second one is you can indirectly double check, not up to this level. Up to a certain extent you can double check, even assumptions you can validate. And third one, you use judgments, and very difficult to estimate the accuracy. If you estimate, if the fair value is estimated by 2 different persons, you get 2 different numbers. But if it is level 1, you get the same number. Even if you ask to do estimate the fair value for 2 persons, you get the same number, as there is an active market for them. Treasury bills, treasury bonds, shares, for all those things, you can take the active market price even for debentures. Right? Okay. Cash and cash equivalents, and the same thing. You can see here the carrying amount, the balance sheet value, and the fair value. Right? So it's mandatory now. You need to disclose debentures, borrowings, all financial assets, financial liabilities, all you need to disclose as per new accounting standards. So there's the accounting standard for financial instruments, and we didn't have an instrument, the standard for financial instruments. After IFRS only, we need to comply with this requirement, and therefore all the companies, you can see if there are financial assets and financial liabilities, there are fair values you need to estimate and disclose, right? And most of the assets, they say carrying amount and the fair value is the same. Unclaimed dividend and payables to related companies, all. Right. Right. So fine. The risk management part, this part also, this is also a new addition to financial statements. And normally there is a separate report, risk management report, sometimes under corporate governance, any enabled report. But now the financial risk management also you need to include under financial statements. Therefore, you can see how they manage risk under financial risk management, right? So they say credit risk, liquidity risk, then market risk, and operational risk, right? So those who are in risk management divisions, you all know the meaning of credit risk, liquidity risk, market risk, and operational risk, right? So different kind of risk, right? What is credit risk? Credit risk?
It is due to creditors.
Okay, yeah. If there are receivables and if they default you, that's the credit risk. As a banker, you lend money, but the customers, as agreed, they don't pay. So that's credit risk. Liquidity risk. Liquidity risk. Liquidity risk.
Your ability to pay on time, right?
Right.
Ability to meet the obligations on a timely manner.
Yes, right. So you need to settle your obligations, as and when they fall due, right? You need to settle your liabilities on the due dates. And if you don't have money to settle your liabilities, then you are facing liquidity, right? So that's called liquidity risk, right? Then market risk. You can go through the notes, right? Just to brief you to save time. Market risk. Market risk.
Mainly with regard to exchange rates and so on, right?
Yes. So when you say market risk, right? And let's take for example, as Chayanka said, exchange rate risk, right? You borrow money in dollars. So even Navlaka Hospital, they borrowed money in foreign exchange, right? And so if you borrow now, your exchange rate is around 190 or 200 or whatever, right? In 1 year's time, if the exchange rate goes up to 300 rupees, so you will have to pay whatever the same dollar amount at the rate of 300. So then you need to spend a lot of money. That's exchange rate risk, right? And also at the same time, you face the exchange rate risk. You can invest your money in long-term investments, right? You can invest company money in a debenture, 4-year or 5-year debenture, corporate debenture, right? So then you fix your interest income, right? If you invest in a corporate debenture, let's say the interest rate is 10%, and you fix the interest rate for next 5 years at the rate of 10%. So after investing in these debentures, if the market rate goes up, you get the same interest rate from the debenture, the company where you invested in debentures, but now you have better opportunities than the investment that you have already made, right? So even the same company, if they issue a debenture, when the market rates up, so they will have to pay a more higher interest rate, right? So there is opportunity cost in that as well. So that's interest rate, the risk, right? And then operational risk is simple terms, right? I'm not using, this is not a risk management class, right? Operational risk
It's due to the failure in operational, like
yeah,
processes, people, or something like that.
yes, yes. So due to failures in operations or processes, examples such as
A system
examples of
breakdown,
operational risk,
a major system breakdown.
major system breakdown, yes, major system breakdown, yes, it's
Uh,
operational risk. Any other?
Errors by the staff.
Errors by the
Any
staff, yes, errors by the staff, or frauds,
frauds.
right? So these are operational risks. So when you carry out operations, you have to have controls to mitigate these operational risks, right? So when you go through this report, you can understand how they manage credit risk, liquidity risk, market risk, and operational risk, right? So the credit risk, impairment loss for trade receivables contract, assets arising from contract with customers and amount due from related companies. So due to credit risk, they incurred a loss of 51 million, right? They had to provide for impairment provision for receivables, so 51 million. So under credit risk, they say, so they provide for this amount. Right. So these are also credit exposure, right? Other investments, trade and other receivables, amount due from related companies, and can, right? Okay. So credit risk, what is credit risk is given. Before that, let's go through the P&L notes, right? So from note 40 onward, we'll discuss next week. Yeah. So we need to take 20-30 minutes next week also. And so from note number 40 onward, we'll discuss next week. And let's go to, yeah. So now I want to go through the statement of changes in equity. This is page number 131. Page number 131. Position is 131. This one. Can you see this? Printed number is 131. Yes, 131. Can you see this?
Yes.
Right. Statement of changes in equity. Right. So as the heading says, statement of changes in equity. If there's a change in equity, we can see it from this report. statement of changes in equity. Equity movement during the year, you can see from this table. Before going through this, what are the reasons to have a change in equity? What are the possible reasons to
New
have a change in equity?
New share issues.
Share issues, yes. If you do a share issue, you get new capital, and so there will be an increase in equity. Yeah. What are the other reasons to have changes in equity?
Dividend paid or cash out?
Dividend payments, yes, exactly. Right. So when you make dividend payments, right, you use retained profit to pay dividends. So therefore, there will be a reduction in retained profits, or indirectly reduction in equity. Other reasons, other examples to have a change in equity. Share issues.
Investment by
Repurchase
the
that
owners.
shares.
Sorry.
Companies repurchasing their own shares.
Yes, yes, yes. So there is an option called share buyback. The company can, so after issuing shares, so in the Companies Act, there is a provision to buy back your own shares. Right? So company issues shares, if you buy Navloka shares, and one day if Navloka wants to buy it back, right, from the shareholders, you can buy it back. Right? So if there's a share buyback, again, there's a negative impact to equity. So you settle, sorry?
It's a mandatory share buyback.
No, it's not mandatory. It's not mandatory, and it's happening in some of the organizations. And why you do a share buyback?
Increase your share.
Yeah, you buy your own shares or the company shares, right? Company issued some shares, and after some time you buy it back. You pay money to the shareholders and take it back. And what are the purposes? Why you do this share buyback?
Then your percentage of ownership goes up.
When your percentage of ownership is goes up, or yeah. Any other views? When you do a share buyback, and why you want to do a share buyback? Huh? So share market investors.
Sir, if you have some excess money, then you can actually buy, right? Reduce the liability.
Exactly, Ramesh. Yes. So if you have excess money, that you can buy back shares. Yes. If you don't, if you think that you don't have any other option, any other better opportunities, so you buy back some of the shares. Right? Yes. Other than that, in which kind of a situation you buy back shares? Good to buy back shares. When the share price is too high or too low?
Too low.
Too low. If the share price is too low, and sometimes share price is even less than the net asset value, right? So then these kind of companies are vulnerable for acquisitions or hostile takeovers, right? To mitigate that kind of a situation, and also to maximize the existing shareholders' wealth. So the one option that you can do is you can do a share buyback. Rather than giving ownership to a third party, you buy your own shares to minimize potential takeover or hostile takeovers or mergers, right? If the share price is too low, and if you think that this is not the right value, the company value is more, so then you go to market and buy it. So you can maximize existing shareholders' wealth. Yes. Okay. So these are some of the examples, and also the one thing we miss, the revaluation. If you do a revaluation of property, plant, and equipment, you can increase value of equity. Right? You revalue, the surplus is part of equity. Therefore, you can increase your equity if there's a revaluation surplus. Right? So these are the possible reasons to have changes in equity. Let's go through this statement. Right? And group, they say the balance as at 31st March 2018. Opening balance is there. and correction of prior period error. So they say there was a prior period error, and 46.1. Please read this note. Right. So they say there is a prior period error. Right. If there's a fundamental error, only you need to go back and adjust financial statements. I think this is a fundamental error. I don't know what kind of error. We need to go through this note number 46.1. If you have the hard copy, just see the note number 46.1. And yeah, we didn't go through. We went through only up to note number 40. Right. Okay. And then the restated opening balance is 1.2 billion stated capital and the evaluation reserve and equity. And loss for the year, the group, the loss for the year 587 million. And other comprehensive income 14 million negative, and dividend paid 70 million paid during the year, and last year 1.1 billion. So this is all these are last year, right? 2018 to 19 period. Opening 1st April 2018 is last year opening balance, and this is the last year closing balance 31st March 2019. Then current year, this year, right? And the restated balance is 1.1 billion, and profit for the year 15 million, and other comprehensive income 27 million, and then you get the closing balance, right? So all these stated capital no change, and revaluation reserve no change. Only change is in retained profits due to P&L and other comprehensive income, right? Other comprehensive income part. Okay. Then company I am not going to go through, and yeah. Cash flow statement, the time is not enough to discuss. And let's see this note, note number 46.1. Can you see this note, note number 46.1? What's the page number? What's the page number?
207.
Correction of prior period error, right? So it's a, they say deferred tax error. Right, what they say? As disclosed in note 14.1 to the financial statements, the subsidiary Navaloka Medicare Center, Navaloka Medicare Private Limited, right, is exempt from income tax on its taxable profit up to 31st March 2022. Right. Again, can you remember the names of the 4 subsidiary companies? They say Navaloka Medicare Center is a subsidiary. Can you remember the names? Yeah, why I say this is, when you go through the related party notes, we need to understand the amount receivable from related parties and other the subsidiaries and others, right? I thought Navaloka Medicare is not a subsidiary. Then New Navaloka Medicare should not. I think it's another company, the related company, not a subsidiary. Yeah, let's go through it again. Okay. So as per LKS 12 income tax deferred tax ruling for BOI companies issued by the Institute of Chartered Accountants of Sri Lanka, a company enjoying a tax exemption period should be recognized deferred tax in their financial statement for temporary differences, where a reversal for such differences extend beyond the tax exemption period, right? So they say this is with regard to deferred tax provision, and bit technical, therefore I am not going to explain. This is with regard to error in deferred tax provision. So that's why financial statement, right? And also one important thing I want to highlight, if it is what are the occasions where you go back and adjust financial statements? Can you go back and adjust financial statement? Sometimes you need to adjust previous year financial statements, right? So what are the occasions when you can adjust restate financial statements or correct financial statement, already issued financial statements, right?
If the error is fundamental and it is material.
Yes. So if there's a fundamental error, as Ramesh said, right? If there's a fundamental error, and if it is material and a fundamental error, and if it is material, so then you go back and adjust, right? You go back and adjust previous year financial statement. What is meant by a fundamental error?
Standard interpretation mistake.
Standard interpretation mistakes, yes. Standard interpretation mistakes, yes. Fundamental errors, right? You know, material transactions. Yeah, Ramesh?
Fundamental means that sometimes asset classification, maybe asset must have been classified as expenses.
Yes.
Expenses.
Exactly. Right. When you say a fundamental error, asset, sometimes you can classify it as an expense. Right. Mistakenly, you classify an asset as an expense, or income as an liability, liability as an income. Right. So these are fundamental errors. Right. And what's the difference? You need to understand the difference between a fundamental error and a change in accounting estimates. Right? Change in accounting estimates. Bad debt provision. Can you estimate 100% accurately? Bad debt provision, can you estimate 100% accurately?
No.
No. It's so you estimated, let's say, 100 billion as bad debt this year, but next year the amount you estimated is too low. You need to provide for 115 million. It's not, that amount is not treated as a fundamental error, right? It's a changes in accounting estimate, right? You use just judgment and estimated. So if there's a change in accounting estimates, we don't go back and adjust financial statements, right? So if there's a fundamental error only, you need to go back and adjust financial statements. You also should understand these things when you deal with auditors. And if they say, you know, go back and adjust financial statement, you need to understand whether this is a fundamental error or a changes in accounting estimates. The tax provision, right? When you provide for income tax, right, you don't know the exact amount. There can be under provision or over provision, right? So if there's an over provision or under provision, you don't need to go back and adjust previous year financial statements. It's not a fundamental error, right? It's a change in accounting estimates, right? These are a bit technical, but at least you should know, if you want to adjust financial statement, there should be a fundamental error. Remember that. Right? Even you can ask from your finance team whether do we need to really go back and adjust previous financial statement? Is this a fundamental error? If you know that, that's enough. Okay. And yeah, so time is over. And next week, I'm going to go through the cash flow statement and note 40 onward. Though we discussed 46, after 40, I stopped. And are there any questions from the things we discussed? We didn't discuss all, right? We need to go through all these accounting policies, all the notes, but due to time constraint, we are discussing only the important things. And so therefore, please go through it, right? Even when you do the assignment, you need to understand financial statements, right? You need to interpret financial statements. Therefore, read all accounting policies. Even if you don't understand, read it, right? All the notes, narrations, you need to read, right? All the narrations you need to read, not only the numbers, right? And also a lot of non-financial information we didn't go through. Strategy, I think we went through to a certain extent, but not in detail. Corporate governance, we didn't go through. Risk management, we didn't go through, right? And all these reports you need to go through. Especially the risk management the part and the strategy part you need to go through. Strategy is very important and to understand what kind of strategy they follow. So therefore you need to understand that, right? So in future, or even in this annual report, please, if you have time, go through the risk management part and corporate governance part, right? Even corporate governance is also important. And if you want to be a director of a listed company or a bank or a finance company or insurance company, you should know the corporate governance requirement. So what are the mandatory requirements, corporate governance requirement for a listed company, right? Okay, if there are no questions, we can wind up the session, right? Thank you.
Thank you, sir.
Thank you,
Thank
sir.
you. Thank you, sir.
Thank you.
Thank you, sir.